The broadcast is now starting. All attendees are in listen-only mode.
Hello, Face Warriors, and welcome investing.com to the best FX webinar on the net, free or paid. Anyone agree with me on that? I just tweeted that out. So we had the Fed yesterday, beige book minutes, whatever the adjective is. It's been my contention for a while that we're putting in a higher low on yields, and I was looking for another wave back up towards 285, 290, starting to look more viable. Most would think that if this was going to happen, we'd get a continuation move in equities because rates going up usually means risk on. But did rates going down mean risk off? No way, right? So even though rates came down, this wasn't because there was a flight to quality or fear or panic in the stock market, right? Because the S&Ps were going up relentlessly. Okay, so let's get to the S&Ps. I know I've cried wolf before because, I caught this and it ended up being a top, but not the top. But, when you're looking for turns, you have to probe things. And even if you don't reach your expectations and you get the turning point right, and there were lots of divergences here, there was, nice scalp here, turned out not to be the high. But this is what has the market exceptionally euphoric. Everyone sees the 200 right there, 200 moving average. So, that's a real stock moving averages, excuse the pun. And I think your first sign, and I think it's possible this week that, we could have some type of top, would like to have 2 days left to try and close lower on the week. That's not going to be a great, you don't need a big crash for that to happen. Lower on the week, 77.60, call it 77. So where we're at right now, we're 5 handles above last week's close. So here's the S&P. This is going to, how are longs going to justify it if this was just a few days to get people exceptionally bullish, and then we close back under the 200-day at 27.50. So that's going to be a real big area. We take that out. I think 2,600 is possible. And this is the S&Ps. Look at the NASDAQ 200-day. Right there. So that's displaying a little bit more weakness. Most of the tech issues in the NAS 100 are broken stocks. All the darlings of last year, Facebook, Google, Netflix, even Amazon, and it was before his divorce and pictures. I'm talking about Jeff Bezos here. And, I'm not looking for a crash, but why not a correction back here, have some targets around 6,400. Could happen fast, too, maybe in a few weeks. So the trader who called wolf thinks that maybe this week is it. And actually had a very interesting guess this week, DAX, extra DAX 30. And Alex does a lot of GAN. And one nugget that he left with us, and, this is part of the service for you guys. Of course, I gleaned from it, too. Alex had a GAN, believed in this number, 144. So Alex also said he thought that we'd have a high based upon the GAN number this week. So it's looking like it's possible. Okay, so that's that. Don't think the dollar's finished to the downside. Still want to see what happens here at 96. We start getting back under 5.5, 580. I guess you could proclaim a pretty large top in the dollar that, we could see the 94 handle, even the 92. My bias right now is that this is a pullback to buy here and, did some trades counter trend. And that we get after we achieve these levels, looks like we could be there by next week, get one more run, and then the breakout over 97.5 is going to give you 99.20 and then 102. But, WD GAN, as long as we're talking about GAN, my favorite expression, I have it written down, and you may want to write it down because I've been stubborn before and have hoped with positions and averaged out. Look, I've done everything, or have seen every mistake someone can make. But W. Gann's saying is, if you don't learn how to change your mind, you won't have any change left. And the best way to not have to worry about changing your mind is to know where you're wrong on every trade before you click the mouse. And then it doesn't become a mental exercise because you've already defined it. And, if you define your risk, it's hard to stay stubborn because it's saying you should be out. So don't change your mind that way, but learn to change your mind. Markets are ever evolving and changing, and new information is coming to us every day. And in my extremely accurate and humble opinion, the best place to get it is here. Okay, right here, ForexAnalytix. And go ahead, test me and email me at djpinkert1@aol.com if you don't agree after taking a 10-day trial that you really found a place that's going to give you all you need, and even more at times. And here's just a look at our dashboard. Now, who goes driving around without a dashboard? Anyone? So maybe you need our dashboard to help you navigate the markets a little better. We could always get better. And it is one of the only places where you're going to get all these different disciplines of technical analysis. Elliott Wave by Greg, Harmonics, Andre. Basic technical is Blake and Steve. Candles, Steve, I think mainly. And macro is Stelio. So you get all of these. You get all the time zones. And more importantly, and I think the most, really, the research is great. But collaboration is very important. I've become a better trader being part of this team because I'm here every day and I see what they're thinking. And because of that, there's a community. Okay, I'm a big believer in communities that are supportive, where you're masterminding together and the sharing of ideas. Okay, so, take yourself out of isolation and try collaboration. And the guys and gals in our private chat, member chat, they don't do this as an avocation, most of them. It's how they support themselves. So, surround yourself with traders better than you, okay? And you'll rise to that level. And they're helpful. So become part of our trading community, part of our trading family, and become a subscriber. If you're overseas, your normal trading in your account could be reimbursed, or you could take a check. Okay, and if you're on the East Coast, most of the guys are going to be there for the Traders Expo, and there's a sign up here. You could register and meet Steve and Joe, and I got Greg is flying in. So we have a couple of guys flying in across the Atlantic to be there. Chance to meet them. Relationships are real once you shake someone's hand. All right, we all know about our internet relationships. You've been friends for 20 years, and then one day they're gone. That would, I think a friend of mine called those, virtual friendships. Anyway, virtual. So make it real, impress the flesh, and go see the guys. And those are my market views. We have an excellent interview today with Vince Lancy. He's a veteran. He's been around for a long time, and he's got some great trading stories to share. And I saw his tweet. He thinks yesterday in silver and gold was a signal for a short-term top, and I concur. And we talked about this too. So we'll see what happens. We're getting some very nice downside follow through. But, people say, oh, well, I missed the top. No, you didn't miss the top. It's just beginning. And you know what? This action right here tells me that there is potential for it to try and retest the highs and diverge, because it was confirming up here. But silver was classic. And I had some out on, but I was early, and then I got out BE because I was underwater. But tell me this isn't classic. And, you know, you could get another run in silver, but look at how after this is why I took my handle, and it was before electronic trading. Don't put your stops over major highs. Okay, give it tolerance because I mean, you know, this high was about 16, 17, and everyone had their stop here. You know, had it picked off just 2.5 cents higher, and you know, you could have had another 25 cents even if you wanted to get out of your shorts. So don't do this. And to me, it does look like you could be setting up some type of three drive. Here's one, here's two, here's three. But on the third, sometimes it has to do some work. We might even trade above, you know, 1630-ish. Anyway, I'm on the alert for that because I do think that this correction was too shallow and think that we'll get something, you know, to, oh no, this was the one that's too shallow. I'm thinking this moving average 1530-ish, 1520, but you know, it's just beginning, and markets normally give you more than one opportunity to do these things. And just the last thing, and I'm going to turn it over to Blake because you know, I can't trade without knowing what he thinks. But I'm thinking the twin sister here, if the S&P's cave, very possible that crude goes along with it. It was a much weaker recovery in crude than it was in stock indexes. And I'm not talking like the bears, you know, $30, but why not a retest of what we came off of here, you know, 51, you know, maybe enough just to flush it, $50 or something like that. And this would be a great buying opportunity. So my dream scenario is a correction in NASDAQ, you know, back to here, and a correction in the oil market back towards 50. So that's it for me. No Sir Pinkert. How you doing, Blake? Blake around?
Oh, I'm here. Sorry, I was just trying to find. I was trying to find my unmute button. How you doing?
Okay. I feel a little better. How about you?
Good. Yeah, I feel a little bit better. You know, and as I went to bed last night, my wife is like, "I'm not feeling too good." I'm like, "Oh man, did I just pass it around the house?" I'm usually not that guy. I'm not that guy that passes it around. So
yeah. All right. Your turn to take care of her.
Yeah, exactly. So first of all, I want to welcome everybody to the Face webinar. And if you guys are new, just keep in mind we do this every morning, same bat time, same bat channel. So thanks for being here. Now, I was just about ready to tweet a chart before you called my name, so I'm gonna tell you what I'm thinking here. First and foremost, this is a chart of crude oil. And, you know, I know everybody's looking at this chart. Matter of fact, I'm gonna tweet it here after I talk about it. But the DSI, which is, you know, a reading that we get every day, and you know, on certain asset classes, and you can see in, you know, FX, and it's a subscription that we have, and it's not my Bible. By any stretch of the means, but it's something that I do pay attention to when I see extremes, and I did not mean for that to rhyme. That's Dale's the king of rhyme, and typically not me. So, but you'll notice that crude oil has a reading of 93, which is extremely bullish. It's a extreme reading, an extremely bullish sentiment reading, which means that the market is, once you're above 90 or below 10, you are in extreme territory where the likelihood of a reversal becomes quite high. You know, it's the analogy that everybody's on one side of the bus and then the bus tips over. Well, in this case, everybody's bullish crude. And when I look at crude's chart and I look at the daily chart in crude, we have this big inverted head and shoulder pattern the market's, looking at this going, man, that's extremely bullish. We're above the 38% retracement, big resistance zone that we punctured through. It looks bullish, but everybody's bullish. And when you have a chart that is prone to maximum failure, which is, I would say that the head and shoulder patterns are probably the most prone to failures. This one is very much in my crosshairs. Now, does that mean I'm trading crude? No, I actually hate trading crude. I'm not a crude oil trader at all. But I like to trade asset classes that are correlated to crude. One of them being, the Canadian dollar, which, as you guys probably remember from yesterday, I'm still long some dollar Canadian. I'm hoping that the dollar Canadian gets a little lift today. Crude actually sells off ahead of Canadian retail sales tomorrow, which you'll see is tomorrow morning at 8:30 in the morning Eastern. So if crude rolls over here, then I'm hoping that the dollar Canadian can get a lift off of this inverted head and shoulder pattern. You can see it's almost a mirror image of crude, and if crude can pull back, the dollar Canadian might be able to bounce back above 132, and I'm hoping it's going to be above 132 going into tomorrow's retail sales number. Then you just hope for a weak retail sales number, and you hope that you put your stops at break even, and hope that the dollar Canadian trades up to 133. That's what I'm kind of focused in right now. Now there's the other chart that I just tweeted about that I wanted to talk about was the S&P. Now, the S&P is approaching some really big tops here. This is the 2820 level. You can see major resistance up there. And let me get rid of this really quick. Lot of resistance at 2820. But what I'm really focused in on right now is that we have this ascending wedge. Okay, this is a 4-hour chart. We have this ascending wedge in the S&P. We continue to grind higher. You can see the trajectory of the S&P is obviously up. Okay, all right. And what you'll notice here is the relative strength has not been moving higher. Relative strength has been moving sideways or slightly lower, divergent, as we've had the strong move in the S&P. So if the S&P breaks down here, you're going to see it probably manifest in the RSI first. And that to me is really important, because if that happens, that jumbles up a lot of stuff in the currency market. The currency market has been extremely non-volatile. And I mean, I should take that back. It's been volatile to a point where, trends don't stick for more than a day. And I was complaining about this in our chat room today. I was like, it's, you got, you buy something one day and the next day it just, falls apart on you, or vice versa. You're short one thing one day and then it just rips up in your face the next day. There's no trends in the FX market right now. And it's predominantly seen in the euro. I mean, you can see, the euro dollar is a great example of the last 2 weeks. We've been bouncing around between this, 113.50 to 112.50. And it's just been extremely frustrating. So frustrating to a point that I'm not even trading the euro right now. I'm not even trading the cable either. The cable is just a disaster. I mean, it's down, hit the 50% retracement, then it rallies, then it's, back and forth all over the place. I'm not even dealing with it. Until we get any type of solid Brexit news, I'm just not even dealing with the cable. You look at the Aussie last night, the Aussie, this one, we were at the 50% retracement. Jobs numbers come in great. The Aussie spikes up to the 618 to 72 cents, just above 72 cents. It slumps as I think Westpac, because I took off to the store to take my son to go buy some pants for school. The Westpac said they call for 2 rate cuts in Australia for 2019. I guess two cuts this year. The Aussie started moving lower, it reversed lower, and then it continued to slump lower as we got news that Dalian, the city of Dalian, which is a Chinese city, is going to ban Australian coal, which is 2% of Australians' exports. Coal exports is to this port city of Dalian. It's going to, ban it due to the, to Australia's ban on Huawei, or I believe is the cell phone or technology company, and the Aussie just got crushed. I mean, just absolutely smashed. And that, but I want to talk about this chart a little bit, not necessarily the Aussie US dollar, but I want to talk about the Aussie yen, because if we're going to discuss the S&P, which I was just in the middle of talking about, we've got to discuss the Aussie yen, because the Aussie yen's been, range bound. Yesterday we tagged the resistance here. And as we were rallying into resistance, I think whoops, I don't know why that's not
and it's since you haven't paid your subscription.
There we go. Yeah, I was going to say, did I not pay my subscription? What the hell happened there? If you're, I think it was the Asian update here last night. Let me see. Or was it
great call, man? It was.
Yeah, there was some Aussie Asian updates about the Aussie was rallying into resistance or whatever, and then it reversed. But the reason why I want to pull up the Aussie yen is because if the S&P rolls over, and this is the chart that I only care about. I mean, as an FX trader, this is all I care about. Now you're probably going, well, that's great. It's not even currencies, but it matters, because the reason why, in my opinion, the currency market is at a standstill is because equity markets are in a grind. The FX market doesn't want to buy risk while the dollar yen is still below 111. Everybody's scratching their head saying, okay, well, why isn't the dollar yen trading at 112, 113, with the S&P higher? And we broke out of this ascending wedge in the dollar yen. You can see the dollar yen.
Look.
I mean, it's just it broke out of the ascending wedge, but there's been no downside. And you're wondering, well, why haven't you seen any downside pressure build out of the dollar yen to the downside? It's because the S&P's stuck. So as soon as the S&P can break lower, let's say I'm right, and let's just say the S&P starts to break lower. We break back towards 2750, 2720. Soon as that dislodges, we're going to see the dollar yen start to roll over. We're going to see the Aussie yen possible double top sitting here, setting up. You got the Kiwi yen failed breakout attempt here that could roll over. The Canadian yen, kind of stalling at this 84 yen level. All we have to do is really just see just a little, and I probably can delete that. I can draw it like this, see a little, Canadian yen roll over. You could see the euro yen, stalling at the 126 yen level. It can't break out. All of this will dislodge, in my opinion, once the S&P moves. And if the S&P is still just, and I could be completely wrong here, and we can spend, and I know, Dale, you were talking about, the end of the week, we could end lower, but how about if we just do this? Yeah. Go into Friday, we just continue to do that. I mean, that this is a 4-hour chart. So that could,
what's interesting, Blake, I showed the yield chart, and to me, it looks like yields are going to go up. And, that could be the catalyst, because, a lot of people are saying, no, the Fed's on hold, Fed's on hold. I don't know what the beige book said or the minute said, but the yields look like they're, bonds, the yields look like they're, the bonds look negative, and 10-year looks like we could trade 285, 290 from here. So maybe that's a catalyst.
Maybe. I mean, maybe the market doesn't like that. But then what happens with bonds? Do bonds bid again, in that situation? And then
maybe maybe we're going to discover that the bonds in the initial stage are not, there's no flight to quality there.
Yeah. It's going to be a real,
it's interesting.
It is going to be interesting. And I'm not sure how bonds and yields are going to play out in a down equity market environment. I don't know if when the S&P rolls over, that yields won't just come right back down again. And that's so
time will tell.
Yeah, time will tell. And I don't know how to approach the bond market right now. It was looking nice and bullish yesterday coming out of this triangle, and then it just, it's rolling over. Maybe that gives us a false breakout. Bonds sell off, yields rally, make stocks reverse, then bonds start to bid again, and then you go, well, what the hell? I was just long yields, and then yields dump, because equity markets came under pressure. So bonds to me are very tricky. I don't really know how to play that, but I will tell you that, I am watching the S&P very carefully, and what I'm really hoping for as a currency trader, and it's not because I'm short equities.
As any kind of trader.
Yeah, as any kind of trader. I just, and if you guys have been listening here for a long or any extended period of time, you would know that in the spring of 2018. So if you go to the spring of 2018, right here, okay, I went to 25% cash in my no, you know what? I take that back. It was in the fall of 2018. It was here. I went to 25% exposure in my long-term investments, my IRA, which I don't faddle with my IRA. It's been, I just don't, I went to 75% cash, and I know I've been sitting in cash for a while, and I did not buy this dip, which I, obviously in hindsight I should have, but I didn't. But that's because I'm really not a believer.
You'll have another one, baby.
Huh?
25.50. You'll have another one at 25.50.
Yeah, I mean, if equities come back down and retest this, this low and holds, I mean, maybe I might revisit that idea. I'm with government's awash in debt right now. It doesn't sit well with me for my longer term investments. So I guess
Blake, the other catalyst could be right before. I just have to say it is there is a possible analog with what happened with Nixon when he was impeached. The market really took a drubbing, and even when Clinton was for a while, it sold off. So I mean, Mueller reports coming out, it could be political competence.
Maybe it is, and the point I was trying to make in equities is I don't have any skin in the game, so I don't care. Other than I just want some volatility, and that's what, as currencies, as a currency trader, we just need some volatility. And the one way we're going to get some volatility is with the S&P dislodging. And that's why I'm hoping that the S&P, even if we get a move from 2780 to 2680, that 100-point S&P move is going to create a lot of ruckus in the currency market. And that, to me, is what matters. I want the Aussie yen to move 300 pips. I want the euro dollar to have a dip to 112 and a rally back up to 115. I want the dollar yen to move from 111 to 109.50 and back up to 110.50. I want that type of volatility, and we're not going to see it while we're grinding up here in the S&P. That's why those of you that know me, and you trade with me daily, that I'm long the US dollar Mexican peso. The thing that's going to help my dollar Mexican peso, which I actually happen to have my long at 1920 now. I bought it on the move back above 1920 2 days ago. The one thing that's going to help it out here is a little bit of downside volatility in equities. So Anyway, those are just some of my thoughts with what's happening with the S&P. I'm going to we have weekly unemployment claims, by the way. Yeah, here it is. Yeah, here I'll stay here. It's not, it's not groundbreaking data. Here we go.
Orders.
Yep.
Yeah.
Weekly jobless claims came in better than expected. Durable goods orders, I mean, came in worse. So, yeah.
We had some Canadian data as well, came in slightly better, but yeah.
There's the Canadian right there. Yeah. So
what will the reporters say about this data?
They're just
oh yeah, the market.
It's S&Ps are under a little bit of pressure right now. Actually,
you do have skin in the game with your peso position.
I do, but not with I'm talking about equities. I'm not sitting here going, here we got I'm short the S&P and I'm expecting a big crash. No, I just want some volatility, and I think that's what we all do. So,
break that line today, man.
Well, we're hoping we're going to get some sort of volatility here. Anyway, I'm going to pass it over to you guys, and remember, if you're in the New York area, make sure you join Steve, Grega, and Joe, and possibly myself. I haven't committed yet to that, but they'll be there for the New York Money Show, and make sure you visit our sponsors. Forest Park FX, they're the ones that help make this webinar that's free for you guys possible. So if you want cash back rebates on your trades, or if you want to get ForexAnalytix possibly for free, join Forest Park FX. All right, so there you go, and Steve's going to show you all about the reimbursement program. You guys have a great one. Thanks for hanging out with me, and I'm going to pass it over to my colleagues. Thanks, guys.
Thank you, Blake.
Thank you, Blake.
Thank you, Blake. Hey, guys, did you hear Blake's rant about I want, all these things to happen? Just something, it made me think, all the expressions I have. What do you think of this? Happiness is wanting what you have instead of having what you want.
Yeah,
I like it.
Yeah.
Do you like it? All right.
Like it.
Wasn't it I just wanted to share a beautiful expression with
That's
everybody
nice.
today.
That's nice.
Helps particularly with marriage. I can say.
Helps no matter what your circumstance is. So and you know what? You can always find something to be grateful for. Something.
That's true. That's
true. You go out, you see a guy who doesn't have, can't walk, and you're out there taking a nice long walk on the beach, and maybe you lost 10K in the market, but you know what? You can walk. So just trying to put the money thing in perspective.
Unless you borrow the market from a loan shark, in which case you won't be able to.
You won't be walking. Yes. Okay. Not only use less leverage, don't use loan sharks' money to trade. Okay. Yeah. That's a good one, Steve.
All right. Steve, before you start,
we had European data today, right?
Yes. Well, let me start. Okay, first of all, the Australian stuff Blake talked about, so I'm not going to talk about again. We had PMIs out of Europe. Interestingly, manufacturing PMI out of Europe and out of Germany in particular was weaker, but services PMI was stronger. So overall, it was overall it was
manufacturing. The PMIs are rather more important. I mean, they really show more the health of the economy, because you know how it is. Produced stuff, is a much better indicator than services usually, or very often. Service professions are lagging a little bit. So
yes.
I still find it worrying that, for example, both the European and the German PMIs are in contractionary territory at the moment.
Yes, that is true. We also had just now, actually, Philly Fed manufacturing came in negative, so much worse than expected. So, the US data seem to have turned. We've been saying this for a few weeks now. Okay, the other thing that happened is we had the usual back and forth between Europeans and the Brits. So we had today Timmermans from the EU making some fairly positive comments. You know, he reiterated that the EU is ready to work with the UK to improve the agreement. You know, blah blah blah. So he said a few things, and the market seems to like it. So it's actually sterling has risen a little bit. There was also reports that a Brexit formal text may be agreed in March. So that also lifted the sterling a little bit. But you know, clearly, unless we see something firm, I'm not believing anything. And the big thing yesterday, we had the FOMC, the meeting minutes from January. If you recall, it was the meeting where the Fed turned dovish, and they, for the first time, suggested that it would be prudent to be patient or raising rates further. Markets, interpreted that correctly, I think, as being quite dovish. And this, the minutes yesterday was a chance for us to see whether this meant that this is a pause or this is the end of the cycle. And we did get some clarity where
I can help you. It's the end of the cycle.
Yes, I would tend to agree. But from the minutes, which you remember, it's a few weeks ago of the meeting, we had some, quite a few members saying that, look, this is done unless inflation picks up, which I see no reason why inflation should pick up at this point in the US. But we did have a few members who said that if the US economy continues as planned, then maybe another raise in 2019 is granted. Now, it's justified. Now, the thing to remember is, as I said before, this was 3 weeks ago, and in the last 3 weeks, the numbers haven't been so nice in the US. So I think even those people who said that, if the economy continues, maybe another rate rise is needed, I think the chances are they might be turning towards the other side as well. But we will know soon enough.
Don't waste your time, Celio. Who do you trust more, me or the Fed? I was saying that the next move is going to be that they're going to be cutting, even before they were saying that the balance sheet reduction is on autopilot and it's not going to change. And the market was pricing in that we're going to get 3 rate hikes, and now the market is almost pricing in that we're going to get cuts. Trust me, this is it. That's it.
Yes, and I've said this before. I've said this before. When you called that, I was thinking, oh, this is a bit, a bit extreme. But you're turning out to be exactly right, and I do think that the next move is lower. So, spot on that, and well done.
I was going to walk away, and I heard you talking, and I stayed. So, great input.
Thank you. You like my squeaky voice, very particular voice.
No, your thoughts and your perspective, is I think some of the best fundamental stuff I hear out there. So thanks for sharing that. And we know Steve's always right anyway.
I didn't say that.
Right,
but
that's not a news flash.
It's not being right. It's being honest. The Fed is just dishonest. You know what I mean? It's as simple as that.
I play Johnny Lang's song "Lie to Me" every time there's a central banker talking.
Yeah, something like that. Exactly.
Yeah. All right, bro. Thank you.
I have some good news. I think that Greg is going to be with us in like 5-10 minutes.
Cool.
So yeah, I have of course things to cover until then. If we have any questions, go ahead and shoot them. I have nothing else to add in the S&P. I'm still short the S&P. I'm looking at exactly the same wedge, and it's not only a wedge. I'm looking at this as a channel, but within the channel, as you see, there is a little ascending wedge. So I have exactly the same perspective. Anyhow, I was looking for a failure, up to the 28.12 level. So I would want to see a move lower. I think that the stock markets are currently pricing in rainbows and unicorns once again, and they completely ignore what's actually happening. That's why I also initiated a trade in the Aussie yen. Before I go to the Aussie yen, let's have a look at the Aussie USD. With yesterday's move, the Aussie USD has not broken down yet. It's currently getting close to this symmetrical triangles support, but The Aussie yen, on the other hand, is getting rejected once again from this broken triangle's support, acted again as resistance, and it even has the potential of building here. You can see this as a potential head and shoulders formation. Regardless, we can even get a double top here. Of course, in order for us to get a confirmation of a double top, we would need to break below this 77 and change low. In that case, we would then have a confirmed double top, and we could be talking about an extension. But in this case, I jumped the gun. This is the second evening star formation we will be getting in some time, and the inability of the Aussie yen to push higher with in combination with the fact that the S&P is currently looking to like it's stalling, like it's running out of fuel, I think make Aussie yen a rather appealing short from a risk reward perspective. I'm looking for at least 100 pips, but to be honest, my first target is actually these lows here. But this is just my first target, because in essence, if we make it there, then I'm going to trail my stop, looking for lower levels. I'm going to be looking for 76 and change afterwards. Then I'm going to be looking for this low, ignoring the week, etc. So my intention is not taking profits if it moves 100 pips. Is to ride this trade if it actually starts playing out. Now, having to do with the cable, and I warned about that since Monday, when the US was on holiday. This was looking like a good formation for the cable to break higher. And after having done that, even this consolidation looks to me like a constructive consolidation in the short term. So I would not be surprised at all, actually quite the opposite, if this gets resolved to the upside as well, and seeing another push towards the 132 previous high. So I think that pound USD looks quite healthy in the short term. Of course, in order for it to start looking better in on the longer term, we need to produce quite a lot more than that. But what remains the case, and we also talked about that quite early. We talked about that actually before it broke down, is that the DXY has now not only produced the head and shoulders formation here on the 4-hour chart, but it has actually retested this broken neckline, and this increases the likelihood that we're going to see further continuation. Now, theoretically speaking, the target would be here at 95.95, but I have to be honest, I would keep it a little bit more conservative, because roughly at 96 and change we have confluence of supports. So I think if we make it there, it's going to be nice, and then we can reassess, because if we actually break below that level, then the whole technical picture gets more complicated, and definitely not in a bullish, not from a bullish perspective, right? I mean, it gets more complicated from a bearish perspective. Now, having said that, let me remember there was something else I also wanted to show before I go into questions. Nothing has changed about USD yen. I still believe that the next move in the USD yen is going to likely be lower. So I have nothing to add there. Let's have a look at the USD CAD. USD CAD, because I don't think I mentioned it yesterday. I correctly predicted that this 133.30 is going to be a key level when we were testing it, and we got rejected. But would I be outright bearish yet? No, not yet, because we have the 200 daily moving average. This trend line here has really no value, because it only passes from a single point. But I was talking about the potential of a triangle, in which case I would need to get something to put this line in its proper place. But I have to say that the fact that we got rejected once again still points to me that there is a decent potential for another move lower in the USD CAD, and that's why I was also looking for the potential of another move lower in the USD MXN, and I'm still looking at that as a potential outcome. Now, I know that a lot of people are looking at this USD CAD as a potential inverted head and shoulders formation, and I have no problem with that interpretation. Although I want to see evidence before I can call that. Okay, so until I see evidence, I maintain somewhat of a bearish bias here, but not a strong enough bias for me to to commit to this market. The only positions I currently hold is the short S&P and the long position that I have in Ethereum. Ethereum is pulling back a little bit today, but I'm still roughly 20% in the money. So, I have no reason to bail out. I mean, I have, a very comfortable trade, and I think it might keep on pushing higher towards 170 in the following days or weeks. So I'm still holding, all of my initial position. What is? Could you comment on NZD CAD? Yeah, absolutely. We can have a look at it. Haven't had a look at it in some time, but we can do that together. Okay, nothing really has changed here. We were monitoring this little channel, and it's still channeling. When we were talking about this channel, I said that it's likely to get resolved to the downside, and nothing has changed. So we can just move this a little bit. I still think that there is a decent potential to see one more move lower in the Kiwi CAD. Even if this is a correction, I think there is one leg missing. So let's also fib this move higher. There it is. So we found support at the 38.2. Oh, Greg is ready. Good. So I'm finishing up with this. So why not one more move to the downside? I don't know, 50% fib, 61.8% fib before we can see, more upside. Hey, Greg, welcome.
Hey, welcome, Steve. How are you?
Welcome. I'm good, mate. I'm good. Great. How have you been?
I'm fine. Just I was wondering, what should I talk about today in the webinar? Because these FX markets, I don't know, they're still very, very.
Start by telling me if you've actually booked a reservation for us to eat on Monday.
Yes, we have everything ready. Okay. So don't worry. You won't be hungry.
I will be hungry. I will have to travel 900 kilometers by car. So yeah, definitely.
We have McDonald's for you.
Hi, Greg.
I'm joking. Hey, how are you, David?
Good, buddy. So,
Great.
Wizard, so this currency action's a little bit nondescript. I want to validate you on calling last week's move in Bitcoin crypto consolidation for a move to the upside, which manifested. Great call. And how about what you're seeing in precious metals? We had kind of a stop hunt in silver and gold. Yeah,
that's what I wanted to tell you. You just passed it. I wanted, because I didn't have time to cover it. We had some nice pullbacks yesterday, especially the pullback from the 88.6, which was the target I was looking for in gold. For the time being, definitely doesn't look like an impulsive like rejection or something. But what do you think? Do you think that yesterday the price action shows a potential for a top, or you think there is more upside coming perhaps towards 1260? 1360.
I think that there is room for more upside. I'm expecting this trend line to be connected from 2016 highs. Because if we take a look at the lower time frame charts, what I'm actually tracking is a 5-wave structure within higher degree wave 5. Maybe yes, maybe. I'm just assuming that if we go a little bit lower, because this is somehow only maybe one leg of these deeper prices. So I just came out with this idea as one possibility here to be an ending diagonal, because there we can see then overlap with this wave 1, of course. So I think that there is still room for another leg up. But then, as I said, once we approach or test this trend line, I would really be careful up there, because if we take a look back, we have been there several times in the past, and I would not be surprised if we just see another failure attempt here. So we will see how this plays out, but definitely, again, I would not be buying gold here, not either selling. So I'm just still on the sideways. And also, something isn't right here, because gold lost correlation with euro dollar. It's now moving forward with including stocks. So I'm just wondering which one is right and or which one is wrong. So I just want to see a little bit more tighter correlations between those markets that normally
purely from a fundamental perspective, having gold rally when in essence the Fed is admitting that the so-called short-term policies having to do with debt monetization are there to stay forever, is definitely unsurprising. So although from a technical perspective, I totally agree with you, and there is a good potential that we're going to see some rejection in the metals. From a fundamental perspective, they have every right to be well bid at the moment, right?
Yes. I mean, my concern is if maybe stocks will make a pullback, which I'm expecting to, then maybe gold could maybe just get even more acceleration to the upside. This is my main concern about.
No, I agree with you, because gold has been rallying despite dollar remaining strong and despite stocks going up. So this is one of the reasons why I'm very careful. Yeah.
So if this turns, then even more money could flow into gold. And what is also interesting, just let me show you here, is I have here the S&P 500, right? Look at this very nice rise. But then you look at Tesla.
V-shaped recovery.
Then you look at Tesla and notice where we trade here. Okay, so somehow those major stocks are not following this, what we see on indices. Here I also have Microsoft. It made a little bit better move to the upside, but still definitely not so sharp and strong recovery like we see on indices here. So I assume that maybe we will see some kind of a consolidation. We are also moving into this resistance here of a former wave swing high. So I just think if we get a pullback, then we are around the corner. To see
okay, so a pullback in S&Ps will give gold another lift. Some fear of light capital. Okay,
it is like
okay, good. Thank you, Greg.
Welcome. So regarding, if we look at the euro dollar, I mean, it's such a tricky price action still since summer of 2018. We are just consolidating here. It can be triangle, it can be flat, it can be ending diagonal. I mean, it's just so many different scenarios here, possible scenarios that I want to stay aside. I just don't remember when the last time I traded euro dollar actually. So I'm just still on the sideline here, and I'm just waiting this consolidation to be finished actually. Either we see
Is it possible, Greg, that your long-term count that this is just another failing rally and we could get some big acceleration to the downside?
Yes, I mean, I'm still on the longer term charts. I'm still looking for the same thing. I'm just expecting maybe with this wave 2 to be more complex, and then we see move lower, or maybe this whole structure, can also be like a wedge here. You see? And
even around 108, 109.
In all honesty, it's so messed up. Why waste brain power, etc.? I mean, I think that the best thing somebody can do with the euro is just let it be. You know what I mean? Trade other stuff.
But what I want to highlight here, that even with this wedge, which obviously should be labeled with a different count, it still suggests that we may see a recovery. But I would assume that we will see 1.12 retested, and then we see this potential move to the upside. So, but as we said, this will be just only a temporary correction still, and on the longer time scale, I still think that euro dollar could move to the downside, while the dollar in general or dollar index should recover. I also have here interesting this longer term chart of commodities. Okay, this is equal weighted commodity index. Actually, it's a fund that tracks Thomson Reuters commodity index equal weighted. Okay, and what we can see here is that actually we are consolidating for the last few years. So I'm seeing this.
It looks like Bitcoin at 6,000. That bottom line, Greg. Bitcoin
that's a good point.
6,000. That flat bottom and it puked. Yeah.
I mean, we will see if this will if this will play out similarly. But I mean, this market is very important for me regarding dollar, because if commodities are really still in a bearish mode, then obviously this wave 5 down from a triangle, which I will be expecting it in the next few years, it means that the dollar should rally even more, and the euro dollar obviously could come under pressure. And this is very important to look at equal weighted commodity index and not CRB index of Thomson Reuters, because there it's just too much percentage of crude oil. Okay, and crude oil can be very volatile, which means if you look at commodity index, the regular one, you may not see the real picture of overall commodities. Okay, so it's very important to look at equal weighted stuff, definitely.
Good point.
Yeah, so I'm definitely looking here for more weakness, and once this resumes, I will be expecting dollar to rise and euro dollar to come under pressure. Okay, so if we what we have interesting, probably the most interesting pair that I'm tracking at the moment can be Aussie. We have seen a nice move to the downside, or I should say a reversal during Asian session. So I'm looking here for another drop here, maybe towards 0.70 psychological level. There will be this trend line support, also 50% or even 61% are around there. So I will be watching this one probably next week. If we see maybe a reversal back to the upside in impulsive fashion, then this will be very interesting pair for potential longs here. Also, yes.
What do you think about crude? Because we have a friend asking, and since you also mentioned commodities and crude, you know, everybody's monitoring at that inverted head and shoulders formation. But in all honesty, it feels to me like you know, the upside is currently losing momentum. So personally, I don't know. My gut feeling tells me that, you know, we're going to move lower first. What do you think?
I mean, this maybe head and shoulders is really completed, but I should be aware of potential retest of these levels around the neckline, which should be, I believe, around 54, around there. So
55.
Yes. So just be aware of this pullback. I still think that for a wave B, this is a little bit small correction, because if it was a correction of a higher degree. So I'm still tracking possibility that we'll see something more complex here. But definitely, I remain bullish. Either we go straight up from here, just continuing higher, and then just we have seen very small wave B, or we will see more upside after this pullback. But I just think that we can be headed up to $60 per barrel. But the idea why we really have to consider potential completion of wave B down there is look at the Brent. Okay, here you can see much more complex correction in the middle, right?
Yes.
So it could definitely be labeled as a wave A, B, and C. And even here, if you take a look at the head and shoulders pattern, then you can see potentially much more clearer break to the upside, right?
That's true.
So that's why we have to consider that maybe crude oil is lagging a bit, but still maybe the breakout to the upside is already here. So, and also you should look at the heating oil as well. You can see the same stuff, much more sharper break.
It looks like Brent, more or less, yeah.
Yeah, so, I mean, these two suggest that we are already making a breakout out of this head and shoulders formation. So I really would not be surprised if we will just continue straight to the upside. That's why I labeled today this potential wave B down there, and even made two wave counts. Let me show you on this 1 hour chart. Okay, the first one is still that we are in this wave B flat formation. So this was wave A. This can be just a sharp free wave move into wave B that belongs to a higher degree wave B, right? Okay.
Mm-hmm. So and then we can either have a running flat or even
triangle.
So, Greg, maybe we get the S&P sell-off and crude sell-off. They both correct at the same time. They've been kind of Siamese twins.
Yes, that would be probably the best scenario. Yes.
Okay. Yeah, that's my wet dream scenario. Oh, excuse my language. I haven't had one of those in let's see, 50 years.
Coach, if at this age, if at this age crude sell-off is what makes you tick, I have no objection to that.
Thank you, buddy. I can't get no satisfaction.
Do we have some minute or two left?
Yeah, go ahead, Vince. I see you here, buddy. We'll put you on after Grego wraps up.
I'll just make a quick update of dollar against Mexican peso. I mean, this was quite a nice recovery, but still it was very slow, much slower compared to the previous decline. So I think this was just a big corrective rally that may send price back to the downside. And I would not be surprised if we see acceleration once we see this trend line, acceleration lower, once we see this trend line broken. It's an extended triangle line. So watch out for potential more.
The only bullish scenario here
if we go bullish, yes?
Yeah, the only bullish scenario here that I see is if this proves to be something like a double zigzag. Otherwise,
yes,
I think we're headed lower, and we should probably start doing that quite soon.
But why I'm expecting a break of this trend line is because on the hourly chart for this recent swing low, we can already see evidences of a corrective movement.
ABC.
Okay, that's not impulse from the lows. While the previous decline can be counted in 5 waves, like in the leading diagonal. So maybe the first leg, okay, was very slow. Now we get a pullback, and then, as you know, the third leg can be very sharp, very extended, like a third wave, exactly. So watch out for resistance around here at the former wave 4, 19.30. I mean, this could be definitely very interesting for potential reversal lower if we see another retest of the highs. Of course, invalidation level is at the previous highs. So, I mean, this one, if anything looks clear to me, then from anything what I see on the FX, then probably that would be the Mexican peso.
I agree with you. One last question that we have before we go to the interview. CAD yen, obviously it will also be very much affected by what the crude is doing. Personally, I think that CAD yen will also fail here. I mean, we're approaching the confluence of the 200 daily moving average and the 61.8% fib.
Yes, I can see here on the right. Yes, we have.
Yeah.
What we have? What I have here? 100 and 200. Yes.
Yeah.
And so we see only 3 waves up here so far to a new high. So always when you see only a 3-wave movement, it can be part of a more complex correction. So yes, this could be wave A, wave B, expecting wave C. And if stocks are really around the resistance, then definitely I'll not be surprised to see CAD yen moving lower. But of course, we have to keep an eye on what the 10-year US notes will do. Ideally, we will see a break to the upside on 10-year US notes from this triangle formation. Just let me show you this real quick. So
I've been showing that every day, that we're in a triangle, and I also said that I believe that it's very likely that we're going to break out to the upside. And
yes.
The same situation with yields. Yields have produced a triangle to the downside, a triangle lower, and I do believe that they can be resolved to the downside.
Yes, and here it's very clearly seen that here were 10-year US notes in uptrend. S&P 500 was downtrend, dollar yen as well. So if this uptrend on 10-year will continue, if we see this cross above February highs to new highs of the
over 302. Greg, let me ask you, and I want to get to Vince. I see like a rally. I've been talking about it from this 265-ish level, that we could rally back to 285, 290, and then go back down to maybe 210. Do you see any possible scenario where that could play out, that we just bounce here and then break down out of this triangle?
here on 10-year.
Yeah, where we go up to 290 and then we take out 265 and head back to the lows.
I mean, this could, as you know, triangles can be very tricky. Maybe this can also be a triangle in a wave B position, right?
Okay. Yeah.
So like that, I would label this as a wave B, and then we see here a move lower for a different wave, and then we move to the upside.
Okay.
That could also be one potential scenarios. But the point is that no matter how we look at this, it's a corrective movement from January highs, and we should see next leg impulsive again to the upside.
Beautiful presentation, Grega. Thank you, man.
Thank you very much.
Thank you, Grega.
Thank you.
Thank you, Grega. Thank you, Steve. Thank you, everyone. And thank you, Vince. I'm now going to make you the presenter. Looking forward to having a conversation with you. Waiting to see your screen, hear your voice. Beautiful. Even a webcam.
Do you hear me?
I hear you. We see you. We got your setup. Vince, very nice to meet you. I think it's kind of a funny story how we met on Twitter. We had like a little Twitter misunderstanding, right?
Well, misunderstanding. You're being a gentleman. I was being
Anyway, so that happens on Twitter. You know, I told you on Twitter, it reminds me of when I was in elementary school, and the guy you'd get in a fight with on the playground ended up being your best friend. So maybe we're going to have the same outcome here, buddy. So
I think odds are yes.
All right, I like it, and no stop on this one. So I know you've been around a long time. No one's been around longer than me. You know, I learned. Yeah, well, I remember having lunch with W.G. Gann and R.N. Elliott in the 30s, and that's where I learned how to trade. Why don't you tell us, buddy, how it started for you, Vince, and
sure
the long and winding road.
I want to make sure. Yeah, I'd love to do that. Thank you for that, giving me an opportunity to do that. Just whatever you see on my screen, I'm not sure what you see, but the only thing that I have here in the lower left-hand corner is that's for annotation. I'm not broadcasting anywhere. That's so I can draw if you need that to be done, if you have any questions or things about that. And I have a camera on in the lower right-hand corner.
Correct.
I would prefer to see you. If that can happen, you want me to close the camera down for screen space?
Yeah, go ahead and do that.
Okay, we'll do that.
And then you'll see your own screen. And yes, we have the dollar index up there and the silver.
Right, that's what we have up there. I also have just so whatever you want to talk to after I give a brief background. I have some charts on gold from a macro point of view. I'm not anti-technical analysis, but I certainly am not a huge fan of it. But I have to deal with it. But to your question, my start in the industry was I worked at Lehman Brothers as a copy boy for Martin Shafroff, a managing director, and I was a fundamental analyst. And the guy I worked for, CFA, would make me call chief financial officers and get all this fundamental information. And one day I asked him a question about options, and he said, "Options? Those are voodoo magic. We don't deal with those." And it turns out they were statistics, which was my education. And I ended up moving from New York back to Philadelphia and took a job with Cooper Neff, who promptly shipped me back to New York. Anyway, I got my training and skill set in options market making and volatility assessments, and have traded every commodity in New York and some equities. And then from there, I left and started my own firm, started trading out of fund, and precious metals and energy are the commodities that I'm most intimate with on a physical macro basis. But volatility is my thing. And frankly, I'm excited to be here because you do a lot of Forex. And I think Forex is underutilized as a trading tool. And whatever you'd like to speak about, whether it be.
Yeah, it's the deepest market out there, Vince, right? I mean, the deepest market is currencies, and inside you could fit global bond markets, and then inside that you could fit in stock and commodity markets. So, to me, it's kind of like the linchpin that everything spins around.
Right. If people, I think, would understand that, would think of it this way, that first of all, acknowledging the size of the markets. These are trillion-dollar markets. Liquidity is not an issue. They're more continuous in their movement. They jump less as opposed to stocks that gap higher, number one. Number two, they're deeper, as you said. Number three, a currency really is, when it comes down to it, the stock price of a country. And the fourth reason is the reason that I like them. I like trading currency pairs because they have less noise. People who trade price based on price, they have to deal with noise. How much is noise? How much is not? FX markets have less noise. If one pair is doing one thing, another pair will do another thing. And you can play with that. I like to trade volatility because it's less noise in the signal. I like to trade FX pairs because it has less noise in the signal. Gold is a currency, not a currency. It's money it's a proxy for the dollar. But gold has a lot more noise in it than, say, dollar yen or even dollar yuan these days.
Okay, interesting. While we're there, do you have an explanation? How people use typical correlations of weak dollar, strong gold, strong dollar, weak gold. And we've had a relatively strong dollar for this whole advance in gold from 1160 to 1350-ish. It certainly hasn't been dollar driven. To me, it looks like it's going up against all fiat. Is that what you're noticing, or how do you explain gold being able to perform during a steady dollar period?
Okay. There are, so I put gold up there on the right for you. There are several factors affecting gold, and I'll categorize them simply as the correlation with the dollar. It's priced in dollars, so the stronger the dollar is, the lower gold goes, and vice versa. That's very important over the long term. The reason that you would own gold is as a hedge for a debased currency. Second is mechanical. Mechanical meaning if someone has to do an irrational sale, like Venezuela, which we can touch on if you want, that would distort the market's relationship with the dollar as someone is forced to sell or someone is forced to buy. Long-term capital management, they were forced to buy. That distorted the relationship. So these are correlations.
How about the low being made at 1160? There was talk out since Erdogan did not want to play with interest rates that was it could have been what you'd label as an irrational sale from Turkey's central bank when we went to 1160. What do you think?
Okay, I think that's actually, although I don't know what the country was, actually put this up on a weekly because I think your point is incredibly valid. The gold market, and I'm going to tie a couple macro points together because it shows cleanly on the weekly to your point about this low here. Okay, this is cash gold. So it's around this time, right, when the market started selling off, and this happened at the same time the trade war started. This also happened, believe it or not, when Venezuela first said they were selling their gold. They had gold to sell, some gold, for example, and this will tie this to emerging markets in Turkey. It's very important.
Cool. All right.
Go ahead, I'm sorry.
No, all right. It's great stuff.
I want to bring it all together because
you're a holistic guy.
Emerging markets is key here, okay? First of all, this sell-off in gold is irrational to the dollar. And this sell-off in gold coincided with Venezuela selling, some emerging markets selling gold, and in general, that was all a function of QT kicking in. Quantitative tightening, right, is basically the inverse of quantitative easing, and in that relationship, the market has less dollars, right? So I'm Turkey. I have less dollars to pay my loans to the U.S. because the dollars are being taken off the market. So what do? I liquidate what I can get dollars for because I have debts in dollars. And this is emerging markets and Venezuela selling. And your comment about the bottom may or may not be true, but I'm almost sure of this. Whoever was handling this order, all right, this wasn't Turkey or Venezuela selling directly. They're selling and keeping it orderly. And this, what we all know, is beating the VWAP. The last sales, I'm a bullion dealer, not to be too paranoid, okay? If I'm a bullion dealer, I'm selling the market for a client, whether it be a country or a corporation, and actually Gold Corp was selling here too. And then near the bottom, right, your last few thousand lots get sold a little bit sloppily because you may be short as well. Not to be accusatory, but that's what happens when you are a principal owner agency. So to your point about to bring it all together, the correlation with the dollar is important, is very important, and will remain the most important thing long term. The market will be strong with the dollar during times of crisis, like Brexit or a war, and gold will drop when the dollar is weaker because of liquidation and other reasons. But the bottom line is there are irrational buyers and irrational sellers of gold that distort the relationship. And the final thing is, the less currencies there are in the world, remember, there used to be a whole bunch of European currencies, the less alternatives are to hedge. And so gold has appreciated against every G7 currency over the last 10 years. And the dollar is actually the weakest it's advanced against. I hope that answers your question.
Yeah, and it was excellent explanation. So then we have to attribute this rally in gold, that QT, which was a major factor,
Right.
and even though gold started up before this in a divorced manner from the dollar, as you said, it could happen. So, there's no, correlations are good till they work, or they have multiple correlations that work at different times.
Right.
So your assumption now would be that the Fed is done, maybe with rates, but do you think they're done with QT, which I think is even more draconian than raising Fed funds a quarter point?
Well, I think, to your point about this recent rally, I think there were several factors driving it, and not the least of which is what you said. The perception that trade wars were going to be resolved really have not had an effect on this. People will look at this, and I can show you information both ways. The problem with China are not it. But I will give you, I'd say, 3 reasons for the market rallying. One is relationship with the dollar, which is not as strong as normal. The second one, one is the QT effect backing off. And the third one, I think, is frankly what's coming next, which would be they're calling modern monetary theory, or Q, or whatever, QE infinity. So to answer your question in those 3 parts very quickly, this here, part of this rally is basically the correction back to where it should be with the dollar. So that's the irrational seller being done. And now you have commercials covering and shorts covering and et cetera, et cetera.
Okay, so, there were record short positions on the COT going into that low. But, if you just went when it was record positions, you were $50 early. So you bring up commercials and the COT.
Yes.
So people have to realize, tell me if you agree with me, that commercials have deeper pockets than most of us. Yeah, and they can afford to be early, right?
That is absolutely true. And in fact, you bring up a good point. The COT this time was so distorted that you would have lost $50 before you were right. It kind of goes like this. In the markets, especially in the gold market, the strong players are the commercials. Now, commercials are bullion banks and dealers and producers. Some producers will sell directly, not many. Most will go through a bullion dealer who can give them one price liquidity, and then they'll sell it into the market. The flip side of that are end users. If you're looking at the industrial side, end users are jewelers and they buy. Very fragmented, not very unified, not very strong in their buying consortium. Who fills the gap between the selling and the buying are the speculative funds, which are by and large long players. So to your point, and something that's been known for years for anyone who gets in the way of a commercial who's selling, the commercials borrow from the Fed at 2%. You borrow off your Visa at 20% if you're a hedge fund, and they have deeper pockets and can stay a little bit longer. Not only that, they have the advantage of having natural sellers, producers coming into the market on a daily, weekly, monthly basis. So the reason the bottom was so interesting here is because, to your point, it was so stretched that the commercials were actually long in silver. They were long in platinum, and they may have actually had a moment there where they were long in gold, which is unheard of. That's how stretched it was. And yet the market kept going down. Usually it turns on a dime when you have the commercials.
Asia session, Vince. So it's interesting. You had a tweet yesterday, and it looks like your work kind of portended a little bit of a pullback and a pause in the move in the gold market and silver market. So, we've talked about the history. I guess people want to know what to do now. Let's just say we're flat gold. We have no position. What would be your outlook? I'm assuming it would, maybe I shouldn't, longer term, be looking to buy weakness. Shorter term, are you looking to scalp this from the short side? And what levels do you think would be a great entry, say, down the road, if we're not running away from there?
If it's okay with you, I prepared a couple pictures to make this go smoother from macro to micro. Sure. I think your audience will be interested. Is that okay?
Yeah.
Okay. It would be hopefully if I can do this right. I'm low tech here, so hopefully I can.
Yeah, you got it. You have the gold CFD and you have red arrows on the bottom.
Okay, so I want to start with, before I get into what I do, I want to start with what other people are doing, and that is. This is a monthly spot gold chart. So we're starting macro here. The two lines are lines that I've drawn, but coincidentally, Jeff Gunlock, who plays gold, has also drawn. All right. And people have drawn a line from the top down. But I want to focus on the blue line. The blue line is a 12-month moving average.
Why did you choose that?
Well,
I wish monthly a year.
I chose, well, actually, I saw some analytical work done on this, and I paid attention to, of all people, Jeff Gunlock, because he's better at giving clues as to his position as opposed to just talking his position. And I noticed that, well, first of all, the back testing showed me that now this is risky stuff, but it's macro. If you buy gold on a settlement, a monthly settlement above the blue line, you will have an average monthly rate of return of 3.5%. If you hold gold, and let's say you're not a short player, but I play short as well, your average monthly loss below that line, the first month below, is 1.25%. And I have the data going back on this in other charts. So I looked at that and I saw, and I refined it a little bit. And that's something I saw somewhere. I won't bore you with it, how I refined it, but it is a 12-month simple moving average. And for me, that's the holy grail or the kiddish cuff, depending on how you look at things. And I tied this to Gunlock because when we broke through up here on the way down, he said, gold is overbought. I'm not going to look to buy it in 1200 area. And lo and behold, and he had done this before when I had seen these other things. So basically, this is a macro way to look at it. If you're a buy and hold or sell and short gold, it's a monthly. It can be painful to not look at it every day. It's not an active trader thing, and these are the trend lines. So the macro on gold basically right now is this: if we settle above 1267 on the month, which it looks like we're going to, you remain bullish gold. If you look at the side of the lines there, you can see that the market has pierced her. Now it's faked me out before. That's one macro thing. The second macro thing, well, that's an explanation. This I think is that's micro. Let me go back. The chat is hiding. This is what we want. We want this, not this, this. Okay.
Okay, yields.
All right. So this is, I'll try and make it a little bit bigger. This chart, I've been looking for a very good correlation with gold for some time, and I think I've found it. Other people have found it too. The blue histogram with the white line is the amount of negative interest rate bearing bonds outstanding, and that number is 9 trillion. The yellow line is the price of gold. I contend that the more negative interest rate bonds that are issued, the higher gold will go. And and we can get into why, but I don't want to go down a rabbit hole with you, but it's very simply this. It's
no opportunity cost.
Well, it's
no opportunity cost to own it, right?
Well, that is the cost of carry, the opportunity cost of owning gold. That's definitely a factor. But I'm going to tie it even closer to central banks. During this time period here, okay, central banks have been buying more than they have in the last 5 years. And the price of gold has gone up. I'm a central banker. I'm a smart central banker, let's say. I'm using QE. So I'm printing euros, okay? And then I'm buying my own bonds in the market so hard that I'm making them a negative interest rate. And that's to get people to put their money in the stocks and hopefully boost the economy. But at the same time, although I won't admit it, I'm worried about the fragility of my currency. And so I also buy gold as a hedge. That's conjecture, but it's increasingly being backed up. The more negative interest rate bearing bonds there are in total in the market, the higher gold goes. So that's a strong correlation, I feel. But
well, you know what? Then let's talk about where they went negative, and that was Europe. Okay, so I think there's a lot of confusion on the euro right here, Vince. Are we going to have parity again? Are we going to bounce back to 120? So to me, it's like ground zero for gold and more negative yielding bonds is Europe. Will the direction of the euro be the tip off of Europe going to negative rates again?
Let me put up my currencies because we're going to start discussing that. Sorry about the change. But let me put up the currencies again. We have, let's put the euro up, right? And then over here, we'll put up the yen, right? Because that'll come into the conversation, I'm sure. Okay. The Europe has a problem that's been going on forever, but they continue to survive. And that is you have a unified monetary policy, macro to micro. You have a unified monetary policy where if Germany lowers rates, everyone has to lower rates within a range. But you don't have unified fiscal policy. So if there's an earthquake in Italy, you can't tax Germans to bring money there. So I believe that the euro is destined to fail. Not tomorrow, not next week, I don't know. But this is all a product of well-meaning globalist academic dogma, trying to create a unified Europe because they have this history, this scar of World War II, and nationalism really is a problem for them. But to answer your question about gold, I think, we know that China is buying. We know that Russia is buying gold. Europe is buying gold too, and I think it's the Germans. Eastern Europe is buying gold because of trade purposes, and the euro is the canary in the coal mine going forward. If Great Britain does pull out, you could see more buying of gold. If Great Britain stays, you can see more buying of gold. But I believe the euro is going to continue to get weaker because of our QT policy, to your point. They are issuing the most negative interest rate bearing bonds. The proof of that is you have the Swiss National Bank buying U.S. stocks. Where else are they going to put their money? There's everything's negative yielding.
Interesting. Okay, so negative euro and great analysis, lower euro. So you're in the camp that strong dollar is going to continue, and strong gold.
That's, you know what? Yes.
Okay.
But I want to put a little timing on it, if it's okay with you, so I don't feel like I'm contradicting myself. All right. For whatever reason, I believe QT is not done. And QT would be the raising of interest rates, right? Like you said, it's worse than just raising interest rates. The raising of interest rates and the simultaneous issuing of debt or letting debt roll off. Now, what that does, if it's done properly, meaning if our government, if our Fed handles it properly, is it strangles the rest of the world to scramble for dollars. To take it to an extreme, let's say there's one bond left in the world, right? And there's $1 left in the world. As they're taking all the dollars off the market, that dollar becomes a deflationary problem for the rest of the world. So I'm Turkey, and I have debts denominated in dollars, and there are less dollars out there. So I have to debase my currency to get more dollars into my country so I can pay my debts back to the US. QT, one of the side effects of QT, we are exporting deflation or lack of liquidity to dollar-based debt, and that will drive all currencies down as people buy dollars. When the world, and now we're getting to when gold rallies hard, when the world is long dollars, if you look at the emerging markets as the poor man holding the bag, when the world is long dollars and China is out of it has de-dollarized its risk enough, you're going to see NERP in the US, you're going to see QE4, you're going to see helicopter money, and it's probably going to be triggered by an S&P print of 2000 or something like that. And then, right, and I truly believe this, I understand this enough, then you're going to see the Fed or whatever they're doing have to do those things, trigger that, and you're going to see stocks explode. Don't get me wrong, as the dollar collapses and gold and precious metals and real assets start to increase.
Okay, so you know what? It's not far-fetched, because look at the crisis we've had in every country that's had a currency crisis. And their stock markets have exploded. You go, well, God, I mean, people are on the street starving in Brazil, and you know, the Bovespa was one of the biggest gainers last year, I believe.
Exactly. And remember in Brexit 2016, after the Brexit vote, the UK, the FTSE outperformed every other stock market.
Yeah.
The booby prize for having the weakest currency in the world that year. Right?
Yeah.
So mechanically, I think people who aren't familiar with how the Fed works, it's kind of like this. Savers have been punished. Meaning interest rates are low, and so you put your money in stocks, and that's fine. Whatever works, I'm not judging it.
Yeah.
But the flip side of it is this: once inflation gets started, if inflation is 5%, I'll make a number up. Interest rates are not going to 6%. They're going to 4%. They're going to consistently lag behind, so real rates remain negative. And why are they doing that? Because they don't want the stock market to collapse. As long as real rates remain negative, then that 4% CD that our grandmother has is not going to be able to pay for the 5% increase in bread.
Right, because the stock market is their cash receipt machine.
Exactly. The stock market is our currency right now. And here's the deal. Yeah. The unintended consequence is physical assets will go up again. Gold will go up. It'll have to happen. And you know, I did a report on that recently, and I can throw the slide up if you want, if we have the time, or I can go into short-term trading, which I think you also may want to talk about.
Well, you know, we're kind of near the end, but what I look at here, Vince, and we could, the best combination. So when this happens, gold will go up, stocks will rocket. Makes me think gold stocks are really going to be the place to be, because you won't have the negative effect of a weak stock market, and you're going to have higher gold prices plus a higher stock market. What do you think?
That is the fly in the ointment for me. As historically, I'm a fundamental analyst, but the gold companies, let me get my opinion out of the way. Gold companies are managed in general, but the consolidation within the gold industry that's happening now augurs for higher prices, at least at first. So are there undervalued gold stocks out there? Yes. And I'm very familiar with who they are. Are there very poorly managed gold companies out there? Yes. I would love to see the GDX outpace gold in a rally. But I want to caution people who buy gold stocks. There are three types of leverage that a gold company has available to it. It's very simple and it's very important. There's financial leverage. They borrow money to mine their gold. So financial leverage makes you outperform the gold market in both directions. There's operating leverage, which means for minimal incremental cost increase, they can pull more gold out of the ground when the price goes up. That's generally one-way positive. So if you're a big company, you use operating leverage. You don't have to put another tractor on to dig up the dirt. It's already there, and all you have to do is just dig faster, your variable cost. And the third thing is this, and this is the one that should not happen but does. You have flat price leverage. These companies that have operating or financial leverage should be hedging in the market, and they do not. And this is a double-edged sword, and I'm telling you that this is why you would be buying of these stocks. Because they don't hedge properly, in my opinion. Goldcorp was a big example of that recently. Because they don't hedge properly, because executives' pay is tied to stock prices, they end up running their companies not as ongoing concerns, but as hedge funds that want to participate even more with